Now I'm going to show you a picture of the history of our debt, which is right over here, to further emphasize what's happening. This basically starts in 1940 and goes up to present. By the way, we did this chart ourselves. I have some crack people in our organization. Now, we came out of the war in the 40s, and we had real good growth, 50s and 60s, and then it got a little inflationary in the 70s, and we had some real inflation there. And what happened is, again, dollars are redeemable in gold. Countries started sending their dollars back to our country, and France, by the way, was the biggest culprit. And they were taking the gold back for our dollars. And in 1976, Nixon officially closed the gold window. He said, we will no longer redeem dollars in gold. Very important point for our country. And that was, 76 is right about here. It didn't have immediate effect, but that began the whole concept that the politicians said, gee, I can give my constituencies more things, and I can print as much as I want because it doesn't have to be a percentage of the gold that we have in Fort Knox. And unfortunately, that idea has just grown and grown and grown. Because you can see we start escalating here. We escalate up to, this is 8 trillion. In the last 4 years, it's 14 trillion. The numbers today are, what I read, I can read as good as anybody, is that this year alone will be another 1.7 trillion, and next year will be another 1.7 trillion. That's 3.5 trillion. So you're going to go from 14 to 17 trillion in the next 2 years, if they don't produce any more, things that they want to give to the public. So you can see the correlation again of, gee, Grandpa says bread was 5 cents. Dad said bread was $1. 10 years ago, bread was $3. Today it's $4 or $5. Just ties right in with the debt structure going up. They're just printing more money and putting it out there, and all costs go up. Now, I'm going to also give you a picture of the interest rates. This is more just a perspective where I think we are over the last 50 years. This happens to be the 10-year Treasury note. I should really put the 30-year yield, bond yield up here, because it went from down here to, in 1960, it peaked out at 18%, the interest rates, in 1980. And now we went all the way down here the last year or two, and it's been sitting at all-time lows here, about 1 or so. And it's just been going up or down, up and down here. Now, I really believe that a couple things. One, this has been artificially pushed down here the last year or two because of the government easing. They're trying to keep the interest rates low now. We have a terrible economy. They're trying to spur the economy on for growth, but so far, it's a question mark. It's just a matter of time before interest rates come through this downtrend line and start heading up. But there are little differences here. The inflation of 1970s really came after the war, when we had some real growth in our country with a little debt, and it was a demand push inflation. In other words, things were growing and growing, and that made prices go up. And then we had the bubble in 78, 80. Gold went from 100 to 800. And then everything topped out with the interest rates at 18% and started down. And then the interest rates have been coming down all the way since then. And just think about where we were and what's happened. When the interest rates were heading up, the stock market was good, etc. And then we topped out, and everything came down. Now, stocks were under 1,000 back in 1980, under 1,000. And as it came down over all these years, the stocks went from 1,000 to 12,000. They went 12 times, because as interest rates went down, it's good for the economy, it's good for business, and the companies could grow. And same thing with real estate. Over these 20, 25 years, we've had a boom in the real estate market up until 3, 4, 5 years ago. It just went up and up and up until it bubbled out. So as rates came down, they made real estate and stocks go up. And commodities didn't do much of anything. They meandered around for 20 years. However, I see a seismic shift going on now. You're bottoming your interest rates out, and I think they would have already bottomed, except for the government easing, which is artificial and will end one day. And rates are going to start going up. But when rates go up, you have inflation. Because if you put a 10% rate on everything you do, you're borrowing money, that has to be passed through the economy. So all your goods and services go up 10%. So you're going to have a double whammy of inflation, the way I see it coming. You're going to have this endless debt structuring being printed, which makes prices worth less, and you're going to have rates going up in their face, which is going to push up even more inflation. And once they start up, the only thing that I see that's going to offset the inflation that's coming, and I don't believe it's even started. I know you've seen everything go up, but I don't believe we've even started the inflation yet. And once it starts up, the only thing I think it can possibly keep you in sort of even with it will be the commodities in general, things you have to have, and particularly gold and silver. So, I mean, that's why I own mostly gold and silver. But over the next 20 years, the stock market, if rates go up, I'm not sure what's going to happen with stocks or real estate, simply because with the rates going up over the next 10 or 20 years, which is what I predict, it's going to be bad for stocks, bad for real estate. But on the other hand, we're printing so much money, people will want to be getting out of their dollars and buy something, so they will tend to buy stocks or real estate. So you have two things clashing. I really don't know where stocks are going. I don't know where real estate's going. I have no idea if it's a good buy or bad buy. What I do know, and where I want to put my money is gold and silver and commodities, because nothing's going to stop once this inflation starts and they keep printing money. We've already seen the correlation between the printing of the money and the price going up, and you know they're going to keep printing money, and that's why I keep my money in gold and silver, because they're going to just keep printing, and eventually when the interest rates go up, you're going to see even more inflation coming. So basically, that's where I have my money. That's where I recommend everybody put their money. And you're going to hear about our two programs after this.